What's up, everyone? This is Ben here, and today we're going to be going over part two of the Burger King Advanced LBO model. And if you guys have been following, then this part one is already created, and this is what, oh, sorry, not this one. This is what we've already built out. And then we're going to be basically using this to build out a more complex model. So this currently, as you can see here, has 196 rows. And let me show you what we're building towards. So this one has 299 rows. So basically, we're going to be adding about 100 more rows. So this is what we're going to be building towards. I want to just kind of give you an overview of what we're going to be adding before we actually start adding anything. So if we go into our cover page, I guess I should start from the very beginning. So if you're totally new to LBOs and all of that, then you may want to start off with this video, which is like a simple LBO model video. We go over assumptions are provided. We go over sources and uses, basic operating model, basic debt schedule, IRR calculations. And then in the advanced LBO part one that I did about a month ago or so, we looked at a real transaction, which is when Burger King got acquired by 3G. And we had to find all of the assumptions, which took a long time. We built out sources and uses, operating model with two scenarios. Then we built out a debt schedule with circuit breaker, and then did our IRR calculations. What we're going to do in this video, which I'm calling the sophisticated LBO model, is we're going to forecast working capital, long-lived assets, cash flow statement, add 2 additional debt tranches, which are the revolver and subordinated notes. We're going to add mandatory debt repayments, cash sweep, PIK interest, and the amortization of financing fees. So this is going to be a lot of I would kind of consider complex modeling that if you can get up to this point and feel pretty comfortable with it, and you're, let's say, recruiting for banking or you're interested in finance, then this will be a pretty good, you'll be like at a very good level if you're able to do up to this. Also, let me go towards the right hand here. So part 3, this is going to be later, but and I'm not wedded to this, so just like as a heads up, this might change, but I might add some of these things. So revenue cases, I may not do the separate historicals tab. I'm more and more thinking that's not needed. Forecasting balance sheet, preferred stock, LIBOR, management incentives, sensitivity tables, adding a DCF, may do all of this stuff. By the way, if you guys could also in the chat, I know we're just getting started, but if you could let me know if the volume's okay. I always want to check that when I'm doing a stream. Besides that, quick notes here. So this model will be available for free when the stream ends. I think this is going to take me about an hour and a half or 2, but we'll see. And then, cool. Thanks, Austin, for letting me know. I have a new Discord channel, which actually, honestly, let me drop the Discord channel a note that I am streaming right now. I've been pretty bad at this. Let me go and give everyone a heads up. In the future, I'm going to be giving everyone ideally like 1 to 2 days heads up, but today was a little bit rushed. And so I wasn't able to notify everyone, but let me shoot a quick message. Hey everyone, sorry for the late notice, but I am streaming the advanced LBO part 2 model right now. Oops. That's the wrong link. Okay, all right, so that's done. And Discord link will be available once, I'll just add it here. That link should work. Yeah, anyway, there's also some videos you can like click on basically. And then if you want to follow any of my socials on my Instagram and TikTok, I've been actually posting short form videos and stuff that are not on YouTube. So check that out if you want. But yeah, this is pretty much what we're going to cover, and we're going to go in this order that you see here. Yeah, and it's going to get quite complicated. And as you can also tell, like I built out everything in advance because honestly, this is like pretty complicated even for me. So I have a monitor up top over here, and I'm going to be adding, or I'm going to be kind of looking up over here sometimes, actually probably a lot, in order to just like double check my work and make sure that we're on track. But you can see here, this is version stream. So we're going to build this out from the previous model, which you can already download and follow along now. If you go to this video's description, you should be able to download this model that you see right here and then start from where we're at right now. Okay. So yeah, that's an overview of what we're going to go through. And then before we actually jump into anything, I have to let you guys know about today's sponsor for the video, which is Wall Street Prep. And they have a private equity certificate program that runs in about a month or so as of the filming of this stream. Goes on for about 8 weeks. And this is a kind of dual collaboration between Wharton, where I got my MBA, and then Wall Street Prep. So two like pretty well-known, strong brands. And this is a really strong kind of certificate program if you're kind of looking to learn from, as we go down here, or actually, let me kind of go through this part first. So a lot of the people who actually attend these certificate programs are people who are actually already in the finance field, although it's definitely open to everyone. So if you're an investment professional, banker, you're in any of these kinds of buckets here, then what you'll learn is introduction to PE, the private equity investment framework, private equity deal process, deal structure, and then of course, analysis, valuation, LBO modeling, etc. How to think like a private equity investor. And then here are the people that you'll be learning from and the keynote speakers. Biggest one, definitely David Rubenstein, co-founder of Carlyle. And then Martin Brand, head of North America Private Equity. I mean, these are also pretty legit firms as well. There are a lot of people working on this program. And then another kind of cool thing that I think maybe a little bit overlooked is just like the peer-to-peer networking. So this program has been going on for I think a little bit over a year now, and they have live events that you're invited to across the different certificate programs that Wharton and Wall Street Prep have. And so you're able to meet people from all these different programs, and they probably work in, a lot of them probably work in finance. There's a Wharton/Wall Street Prep group on LinkedIn. And then you can also, there's some exclusive recruiting events as well. So feel free to check it out. You can use my code RareLiquid to get $300 off. And if you sign up by the early registration deadline, get an additional $200 off. So that is Wall Street Prep, Wharton, the sponsor for, or Wall Street Prep is the sponsor for this video. And then I have a bunch of these filings here that we're going to be going over in as I go throughout the stream, and they're also linked to in this video's description. So you can go to those links whenever you'd like as well. So with that said, let's kind of jump into what we're going to be doing here. So first, we're going to be forecasting working capital. So if you remember at all, actually also in the chat, let me know if you were in the last stream for the LBO model. I'm streaming at a very different time than I normally do, so would kind of be surprised, but let me know if you were in the previous stream as well. But what you see here, last time what we did was we just went to the cash flow statement and then we got the changes in the operating assets and liabilities. But this time what we're going to do is just kind of forecast working capital ourselves. And it's not going to actually be too complicated. The majority of the work is really going to be in collecting the historicals. And but it's still like a kind of a good exercise rather than just taking them directly from the cash flow statement. So what we're going to need to do is go to the 10K. This one is 2011 maybe. Oh, it's 10KT. So this 2009 one. And by the way, I will, if you guys have any questions as I work on the stream and everything, I will be answering them in a few, like in bursts. That's the word. So feel free to ask away questions and I'll get to them when there's like a natural pause. So what we're going to do is we're going to, the cash flow statement is something that you create using the income statement and the balance sheet. And so what we're going to actually just do is take directly from the balance sheet and take every single line item that's relevant essentially. So as you can see here, you have trade and notes receivable. I'm just going to, let's just copy paste this. And I'm going to use a percentage of sales when projecting this. I'm going to add that there. Prepaid and other current assets. Also percentage of sales. And what I'm going to do is actually lump our prepaid, other current assets, and deferred income taxes because I'm going to treat them the same just as a percentage of sales. We're doing that the same thing for accounts receivable as well, but this is like a pretty significant current asset, so that's why I'm gonna treat it a little bit separately. Misclick there. Okay, and then so these three are really our current assets, right? And then we have our current liabilities here. So let's get our accounts and drafts payable. Normally, you actually project this out as a percentage of COGS, cost of goods sold, but because for reasons I will go into later, I am not going to be doing it as a percentage of COGS. So, let's worry about formatting a bit later, but now it's like kind of tedious work. Normally, actually, maybe even on the job, sometimes you'll actually have to do this because you just can't rely on FactSet or whatever. Sometimes you just have to manually do things to make sure it's 100% correct. So we have numbers here that we can just copy paste. So control copy. All right, so that's 2008. And then we can get 2009. And there's always a temptation to just enter in the numbers with your keypad. But if you do that, you're bound to make a mistake. And so it's always good practice to just copy paste. If you're working in banking, that is. If you're just doing this for fun or whatever, then, you don't have to do it this way. Okay, so yeah, tedious stuff. If it makes you feel any better, this is my second time doing it. Okay, so we have our current assets here. Accounts and drafts payable is down here. So this is for 2008, 129.5. Accrued advertising here. And honestly, I could lump all of these together as well, but I'm just deciding not to. Okay, now we would advertise. Oh, wait. Accounts draft payable here. Accrued advertising. Accrued liabilities. Okay. Ooh, okay, so we got it for 2008 and 9. We're going to have to go then to our 2010 10K, again, which is available. You can just download, or sorry, you can just go to the link in this video's description and get to it quickly if you want. But this is a 2010 10K. And we just need our 2010 numbers, which are right here. So we're going to get this 142.9. And you can see this 130 should be exactly the same as this number here, since they're historical figures. Then sometimes there's like adjustments that are made after a 10K is released. And then so you do at times have numbers that are different, but I think that's more rare. Accounts and drafts payable over here. This is basically like accounts. Yeah, it is accounts payable. And then accrued advertising. And then other accrued liabilities. Okay, so we have our numbers, and then what I'm going to do is control copy the formatting which I want here, and then Alt EST for formatting, and then control copy these three cells, control shift right arrow key, Alt EST. Oops, that didn't work. Control copy down, Alt EST. And then you can just go down and press F4, which just copies exactly what you were doing in your previous action. And then as a percentage of sales, so let's go up here. And then I want to make this look like this. So Alt EST. I'm going to anchor this row here because we're going to use percentage sales a lot, right? So I press F4 to anchor the row 56, and then I can just control copy paste this in each row. So let me now go a little bit into why we're not going to be using COGS in order to project our accounts payable, which normally you want to do that. And the reason for that is basically when your COGS are growing at a certain rate, then your accounts payable should also kind of be going at that rate, because accounts payable is basically what you owe to suppliers, right? The cost, and if you owe money to your suppliers, that's basically what you owe to people who are building or supplying you with the materials and whatever you need in order to build your products or provide your services, right? So your accounts payable should be linked to your cost of goods sold, and your accounts receivable, and honestly, a lot of these line items can be or should be related to your cost of sales, because they should kind of grow in proportion. The reason we're not doing that for accounts payable is because, and originally when I was like preparing all of this stuff, I did do it, and then it got I realized it was just totally wrong, or it just would not work with this model unless I fixed a bunch of other stuff. But you can see all these like blanks in here, right? And that's because if you remember from the previous model that we built, we don't have the numbers to fill these in when the case is at 2, which is management case. So if we go to like our own case, which I'm calling the conservative case, then we do have cost of goods sold. And we can see how it's declining over time, which you want to see as a business. But when we go to our management case, we don't have that, basically. So then that means we either need to project out our cost of goods sold and all of this stuff for our management case, or we just base it off of sales. And the reason I decided to base it off of sales and not try to project out all of this is because everything here is really working towards these management projections that we got from the pre-merger agreement 14A page 60, which is this document here. If you recall from the last stream, there is a section in this document whenever a transaction kind of happens where they discuss what management projections were as of the time of the transaction, right? And we wanted to be basically building towards, or we wanted to be using these numbers because these numbers are what 3G Capital, when they acquired Burger King, also were kind of looking at. So that's why you know, if I were to try to like back into this number, then I would just have to like just come up with a bunch of fake numbers. So, and I didn't think that was like such a great idea. And so that's why, that's my spiel of why we're deciding to do everything percentage of sales instead of percentage of COGS here. Okay. So eventually we're not going to need any of this. But basically what we need to do now is get our change in working capital, right? So I'm going to delete, I'll just delete these three for now. So that's just our current assets minus our current liabilities, or current operating assets minus current operating liabilities. Well, actually, sorry. This is change in net working capital. Let's get just our working capital first. So this is going to be net working capital. And this is going to be the sum of our current assets minus the sum of our current liabilities. And I guess I realized that we didn't project things out, but we could do that really quickly right now. So we're just going to use a very simplifying assumption, which is that we're going to use the average of the past 3 years. And the reason you can also kind of feel comfortable about that is that these numbers don't really jump crazy amounts. I guess the one thing you could say is that they are relatively kind of going downwards. So you could potentially argue that it'd be better to kind of go with the trend. But I think an average over the past few years is totally fine. And I'm going to make this purple because purple means you are linking to a cell in the same sheet. And we are doing this as a percentage of sales. So we can just multiply this by our sales number that's up here. Do some formatting here. And then we can just copy paste this down for each row. Oops, I did not anchor this. So F4 to row 56. And then you can multiply this down. And then so since everything really is following like a similar pattern, we can just copy paste these down. And so that's our working capital. And I'm going to add a period here just to keep track of the different rows that we add or change, just so that later on when you have this model, you can kind of kind of figure out like what has been changed. So net working capital we calculated here, and we can just copy paste again across. And this is our working capital, right? Current assets minus current liabilities. This is also our current operating assets minus our current operating liabilities. So like we don't include things like cash or short-term debt, for example. These two are going to be empty. Oops. And so here we want our current year minus our previous year. And this allows us to get our change in net working capital. All right. So you can see sometimes you have a cash outflow. I found that actually pretty interesting for Burger King. I would have thought that Burger King would be a company that had positive net working capital, meaning that they're spending more. They have like cash outflows because they need to like pay upfront, let's say, for their cost of goods sold and all of that. But it doesn't really seem like that's the case, right? They actually have a cash outflow in some of these years, partially maybe because of the way that we forecasted things. But at least in this 1 year, maybe actually this should change. First, let me copy paste this formula, make this black. So these are now as of a percentage of sales, and This is just a calculation now. As I'm seeing these figures, so we have 8.6% of sales, 6.5, 5.3, and then a flat 6.8, which is pretty much, I think it might be close, if not is the average. Yeah, since we just did averages up here, they're just like an average of the past 3 years. I think we may need to change something a little bit. You can see that other accrued liabilities is kind of going down, a downward trend. Accrued advertising is just similar. Accounts and drafts payable kind of on a downward trend. That would change things quite a bit. And then accounts receivable kind of going up and down a bit, and then same as prepaid and other current assets. So for me, what it kind of seems like is our accounts payable and then our other accrued liabilities, these two maybe should not be as high or not be like an average. This is going to be like just like a bit of a shortcut, but let's just take the previous or the most recent year and assume that it stays flat. So, you could definitely spend a lot more time with this assumption, but I'm just going to write here, given downward trend, use last year as projection. I'm going to add that here as well. And I'm going to just add a note here that this is from the 2009 10K. And this is something you should always be doing if you are working in banking as well, or whatever you're honestly doing when you're doing this stuff, I guess. You want to add comments so that whoever is looking at your model in the future can kind of easily just go to wherever you pulled this information. So you can add that here, and you don't have to do it for every single cell. Like obviously this is something, if they know how models or how financial statements work, then they're going to be able to look at all of this stuff and know that they all come from where this comment is. 2010, this comes from page 72. Okay. So there we have our working capital. Let's see how things have changed. So it goes to -6, 26, 12, 1, -6. That's probably also partially just because of the sales figures that are kind of weird here. But these are, based off management projections, as we went through in the last LBO video. All right, so we have our net working capital. We have our changes in working capital. So now these numbers should be pretty irrelevant. So if I delete them, nothing should change in the model. And we can also delete these. Let me add these periods for what we changed. And so that was the first thing that we planned to do, which was forecast our working capital. Next, let's go into forecasting our long-lived assets. So as I kind of transition to that, I will answer some questions you guys have in the chat. So I see the first one asks, hey, where do you find cases for these LBO tests? If you go through to this video, actually, I built it completely myself. So no case. Will banks look at my resume if I have models like this but no degree? Probably not. They do care a lot more about you having like a degree. I've had people in the past send like a financial model and say like, hey, look what I can build, but that's not really what banks are looking for, that you can, like, because for all they know, you might have just downloaded this and then sent it to them, right? So they want to see you have a degree more often than not. Next, I'm currently doing a Wall Street prep course. Is there anything more I need towards PE recruiting? How would you highlight for entry positions that you know how to model? That's really based on what's on your resume. If you have financial transaction experience or anything like that, then that's really the best way to show that. 9 a.m. in Australia, 1 a.m. in Poland. Going to be faster to split screen and type manually. Not sure what that was a what reference to, but okay. Next, forecast long-lived assets. So let's go into that next. So first of all, long-lived assets, these are basically, in other words, long-term assets. And so I'm just going to add a bunch of rows here. And we're going to add basically a new section. Okay. So a lot of this is going to kind of use, at least the first two are going to be similar. So let's just copy these rows. So I'm going to call this working capital. And then I'm going to call this section long-lived assets. And I know we already had our DNA and CapEx figures here. We're going to change things up a little bit though, but I'm not going to actually go back into the financial statements and get these numbers because we already found them, right? I'll show you very quickly where they are, but we're not going to like re-copy paste them because that would just be a waste of time. But we're going to get our, all right, let's do our CapEx first. And then our DNA. The percentage of sales and percentage of CapEx. That's why we're going to do our DNA second. We can delete these comments. Alt-RD deletes the comments. And then I'm going to delete all of this stuff. CapEx. So we have the numbers. So I'm just going to copy paste these three, go up, or copy these three. Alt-ESV. That copies the values here. And then again, percentage of sales, we can just use this one that we had earlier. DNA, we can do a similar thing. We had the historicals earlier as well. And then we can get the percentage of sales and then also as a percentage of CapEx. Let me show you very quickly where you can get this figure if it was your first time getting it. Basically in this cash flow statement here, I don't know why for balance sheet they only give 2 years, but cash flow statements they give you 3 years. So if you go to like depreciation and amortization, for example, you can see the figures here. But I just realized I remember there's something really tricky about this depreciation and amortization, which I need to go through. But this is basically where you get the figures. So page 75, 2010, 10K, page 75. Okay. So the reason that we need these numbers is because we're going to forecast our plant, property, and equipment. And it's going to kind of look similar to our debt schedule almost, where we're going to need things like our beginning balance, depreciation, CapEx, etc. So for this, we're going to have our beginning balance. We're going to have capital expenditures, which is basically our additions of PP&E. And then we're going to have depreciation, which lowers our PP&E. So the tricky thing, and the reason I'm going to change up some of these numbers, is that this total DNA number also includes amortization, which is basically the depreciation of long-term assets, which we're going to go through when we go over like intangible assets. But this depreciation figure that we want is actually going to be only depreciation. We don't want amortization, right? So then the question is, how do we actually get that number? So if you look up accumulated depreciation oftentimes you can get some information about this. So you can see here, basically, right? Depreciation and amortization expense on property and equipment totaled 120.6, 110.1, 116.6 for the years 2010, 2009, and 2008. So these are actually the figures that we want in here. But I kind of was doing some thinking about all of this. So 120, so for example, right? 120 point, oops. 120.6, 110.1, 116.6. Right? This is what it says here is the DNA related to property and equipment. But the actual DNA figures, which if we, let's say, go to our cash flow statement, are these figures that we found that are here, right? 111.7, 98.1, 95.6. So then basically the issue here is that we have actual cash added back that's a lot less than just the depreciation and amortization. Basically, this is just really weird. I thought a lot about like what to do, because ideally when we are later on like projecting our cash flow statement and all of that, we kind of want to, at least in my view, use the numbers that are in the cash flow statement. What I would love to see is for these numbers to be like 85 and this to be like 87, whatever, like 100. Then you can easily just say, okay, this is our DNA. These figures we use for our depreciation, and then our amortization is the remaining, 96 minus 85 or something like that, right? That's what's ideal. But that's not what we really have here, right? So I kind of decided to back into this figure after we calculate our intangible assets. So we actually need to, in order to kind of basically like fill out this entire section, we need to first work on intangible assets, and then I'll kind of bring everything home once we project out our intangible assets. So intangible assets are going to be very similar to plant, property, and equipment. So we have our beginning balances, then we have purchases or impairment, and then we have amortization. Intangible assets can be a lot of different things, but oftentimes it can be, the most common example people use is like patents, right? Like you can't touch a patent per se. You can touch like the paper maybe if it's like printed, but it's something that that is an asset that maybe you purchase and have or whatever, but it's intangible in a lot of ways, versus plant, property, and equipment, which is an asset that is physical, right? Like a factory, a computer, a chair, etc. And these intangible assets, even though it's kind of weird to think of it this way, they also amortize over time, meaning that they depreciate over time. So just as how if you buy a car and it decreases in value over time, an intangible asset also decreases in value over time by a steady rate. So let's get these figures. So I'm going to delete this because it's not really needed. Intangible assets, let's go to our balance sheet. Okay, so balance sheet here. Let's actually start with our 2009 one. So we get our 2008 figures. Intangible assets. So here, 105.46 is for 2008. This is our beginning balance. And we have our ending balance, right? Which is here, right? As of June 30th, 2008, actually, this is our ending balance. All of these numbers are as of June 30th, 2008, which is, or June 30th, which is the fiscal year for this company. So that's the ending balance. The beginning balance is just the ending balance of the previous period. Literally, there's no time that has passed between these two. It's your ending balance is your beginning balance of the following year. And we want to make this purple. I guess I don't have it somewhere. Alt HF's actually going to be easier if I find somewhere. Yes, here we go. Okay, so I'm going to add here, this was 2009 10K, page 73. And then we can also add our 2009 and 2010 figures, right? So we can go to intangible assets, 2009, 1062.7. And then 2010, 1025.4. What the? Oh. Okay, and then add a comment here. Shift F2, 2010, 10K, page 72. Alt ESC is adding a comment. And then we're going to have to do something that's a little bit... we're going to have to back into some of these figures, but basically... one thing that we need to check is our amortization, right? Like what is this figure here? And so if we go to our 10K figure, and again, it's just like how we're looking for this for depreciation, we can look up accumulated amortization, and you can see the company recorded an amortization expense on intangible assets of 8.7, 8.85 million in the fiscal years of 2009, 10, 9, and 8 respectively. So that's 8.7, 8.7, 8.8, and 5. And then it says future amortization is 8.9, 8.8, blah, 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 all these numbers, right? So then we can basically use these as projections. So that's what I'm gonna do. 8.9, 8.8 in 2012 and 2013. 8.6 in 2014. And then 8.2 in 2015. Right? And probably because 3G is acquiring this company, Burger King, in this whole, transaction, or this LBO that we're building, these numbers probably, there's a chance they could change, because whatever Burger King's intangible assets are, they could be affected based on what 3G decides to do with everything, but that's beyond our scope of what we can know. And so we're basically assuming, okay, 3G is going to pretty much let Burger King's intangible assets just be how they are. And if that's the case, then amortization is basically just accounting. And so we're just going to assume that this stays as the financial statement says, basically. And so let's calculate our beginning balance, which we don't necessarily need to do, but we're going to just do anyway. And so I'm just going to assume that there's 0 purchases or impairment. And so the formula is you get the ending balance, you add your amortization back essentially, and then subtract, I believe, any purchases. So this will get you to 1,060. And then, so that's just for this figure. So let's say we make this 10, then this should be 1,050, right? Because 1,050 plus 10 minus 5 should get you 1,055. So this formula is correct. But honestly, it's really irrelevant. We don't really need that number. And then for this line here, what we're going to want to do is kind of back into this figure. And so in order to do this, what we're going to do is get our ending balance and then subtract our beginning balance. So what we're doing here basically, and you can check this, right? We got our beginning balance plus any purchases minus any amortization. Oops, that is not correct, actually. I think I'm missing. So purchases and impairment. We should be getting this number, adding this number, and subtracting this number. Yep. So then we're backing into this number, which is fine. And you'll see why like I kind of decided to do all this, but basically now what we can do is copy paste these formulas across. And this is beginning balance plus purchases minus amortization. Actually, this is weird. Okay, I think I'm gonna need to do a different formula here. So for this one, what we're just gonna do is, let's see what I did in the other model. This is a bit circular. Okay. Did I do this? So what I want to assume is basically let me think about what I wanted to do here. So we can't really make too many assumptions about what purchases they may make in the future for intangible assets, right? We don't really want to be making this kind of assumption because like really anything can happen. So in that case, basically what I'm going to want to do is make our intangible assets ending balance just flat throughout the entire projected period, right? So basically if I do that, what we're assuming is that our intangible our purchases they're going to be the same as our amortization, right? So that just keeps everything flat. And this may make you think like, oh, why are we even doing this? But you'll see why. So we have our intangible assets here. And then now we can talk again about our depreciation. So as I mentioned earlier, we do have these DNA figures, but they're different compared to what is listed here, 120.6, 110.1, 116.6, right? And I want to stick to as close to the cash flow figures that we have here as possible. And so honestly, I'm not sure if this is the most accurate thing to do. And it may really just not be accurate. But what I'm going to do is just get this entire depreciation and amortization figure that's on the cash flow statement. And then I'm going to subtract out the amortization from our intangible assets. And there may be amortization of other assets, other long-term assets somewhere, but I'm going to assume that these are our only intangible assets, essentially. Let me make sure I did this correctly. Oh, oops. So it's equals 95.6 minus 5. This is 98.1 minus 9, and then this is 112 minus this 9. And so 91, 89, 103. So essentially, these figures are in our cash flow statement. $111.7, whatever, right? So later when I'm calculating our DNA, which I will here, right? I'll get DNA plus amortization. Then these numbers don't change, and that's what I wanted. So that's why I'm doing it this way. If any of you guys are super good at accounting, then let me know why I'm having there's this issue where depreciation for plant, property, and equipment is a lot higher than what is shown in the cash flow statement. And I know that that's normal in the sense that a lot of times you don't add back all of the DNA in your cash flow statement that you deduct in your income statement. So I know that's the reason, but then in terms of like what's best to use for this LBO, I'm not entirely sure. But this is the way I decided to do it. Let's call this depreciation of PP&E just to be a little bit more accurate or more descriptive. And then we'll write here 2010 10K page 75. And then I'm going to say backing into this number. Backing into this number in order to tie with DNA on cash flow statement. Okay, and I'm going to copy paste this comment. So now we have our depreciation, and then now we can, that's why I was talking earlier that we actually needed to forecast this first and then work on our PP&E. So plant, property, and equipment, we can get that by going to our cash flow statement, balance sheet. Okay, so we have 960.7 at the end of 2008. Right, so this is our ending balance. We actually don't need to, I guess we already have the numbers, but capital expenditures, 178 here, depreciation here, oops. We can back into this number. So it's that plus our depreciation minus our capital expenditures. So that's our ending balance there. We can, let's see if these, kind of realizing, I'm not sure if this is going to tie. That's not. 1001, 1013.2. This is also problematic, actually. Realized. Okay. So let's see. The numbers that we for sure want to tie are these figures here. And then sometimes there's like additional sales of PP&E, or like, as we just saw, some like weird depreciation numbers that come about. So I think the most accurate thing to do here is to make sure that these ending balances are tied, do tie here. So as of the end of this number, it should be this basically. Then 2010 Plant, property, and equipment and the balance sheet is 1014.1. So if you do this add and then subtract here, you can see that our numbers are bit off, right? So then that means like either our capex, I guess in this situation, our capex needs to be larger or depreciation needs to be smaller in order to get to, 60 more here. And then similarly here, we're like 50 off. Okay. That means we're going to need to back into one of our numbers again. I don't love. Given that these are historical figures, even though they should be tying, there's not much. We can't really dig into too much. Like what I'm going to just do is make these red, then add. I'm going to add a comment here that says does not tie to ending balance, but included as reference. So I'm gonna include them here as reference, but these, these are the true historical figures, right? These cannot be changed. These numbers, it probably like basically what this needs is like 260-ish, 275, right? Is this supposed to be less? Oh, less. Call it like 142, right? And then it'll match. But we have like 204. So I'm just gonna leave these. Clearly these numbers are not correct. There's something else going on, but I don't want to look into it too much. It'll be 2009 10K page, and I'll show you guys in a bit why it's not really troublesome, because we're just gonna project out using this 2010 10K page. This is page 72. Okay, so we're going to be using these historical figures. So average of the past 3 years should be fine. And we'll just use 7.1% here. And then let's see what things look like for these. By the way, if you're unaware, your capital expenditures are directly linked to your depreciation. So whenever, let's say you buy a chair and that chair is useful for 20 years and you're deducting in your income statement depreciation expense of $100 to buy by 20, let's say $5 each year, your depreciation and your capex, there's always this relationship. And that's why people like to look at your depreciation in relation to your capital expenditures. And I think what I did in my model that I preferred to use was the percentage of capex. So let's calculate this to our sales first. Then we can calculate this as our depreciation as a percentage of our capex, right? And so then we have the numbers that we need to forecast our plant, property, and equipment. So we have our beginning balance. Then we have our capital expenditures. Then we have our depreciation and amortization. And then we can get our beginning balance plus our capital expenditures, basically what you spend in order to gain more PP&E and depreciation, the actual cost of, or the deduction of, oops, the deduction of the value of your PP&E, essentially. And then if you copy paste this across, basically we have projected out our PP&E for the next 5 years. All right, so those are the kind of biggest or long-term, long-lived assets, and we have a few more line items to just have here. So one is going to be goodwill and other assets, and the other is other liabilities. The liability is obviously not like an asset, but we're going to include it here. Okay. The goodwill and other assets, again, kind of tedious work. We're going to have to go to our 10K, goodwill and other assets. So essentially what we're basically trying to do is get almost every single line item in the balance sheet, and we're going to use them for our cash flow statement to make sure that basically everything is accounted for. So we already went through these. We just did these two, and then now we have these three, right? So what I'm going to do is lump these three together. So for 2008, we have goodwill of 26.6 plus, or sorry, well, yeah, that was goodwill. Net investment in property leased to franchisees of 135.4 plus other assets of 105.2. And then we can do the exact same thing for 2009. So equals this plus 135.3 plus 98.9. And then we just need it for one more year. So let's go back to our balance sheet. And then we have 31 plus 138.5 plus 104.2. And since these are all hard codes, we want to make these blue. And then we can say same comment here. Other liabilities. So let's see what they have. So we accounted for these already. Long debt, we don't want. Capital leases. So we don't, in our model, we don't consider capital leases as a part of debt. So it may be a little bit, I don't know, controversial, but for me, I'm going to lump these three together. But ultimately, it's not going to actually affect anything, as I'll explain later. For now, though, we are going to basically lump these three together. So capital leases, 71.2. And I guess as a preview as to why it won't matter. Ultimately, we're just going to keep everything flat. And when we go to our cash flow statement and then use these numbers, what we're going to do is just get the change of the figures. And since everything is going to be flat, we're not going to actually, it's just going to be 0. But, you know, I'm just building this out so we have like a functional model. 2010, 5.3. Basically, I guess what I'm saying is, I think it could be argued that you don't want to include capital leases here. All right. So we have our line items here, and we're just going to, as I said, keep these flat. Double checking, and I want to make sure I got these correct. Okay. So this number is not tying with what I did earlier. So let me just double check this number. Oh, but I did it wrong in my previous one. So this one is correct actually. Okay, so we going back to what I said we were going to go through today. So we forecasted working capital, we forecasted long-lived assets, and now we're going to go through what honestly is the much more complicated kind of part. So let's just put an X here. So we went through these two things and then we have all of this stuff left. All right. So DNA, first of all, we do need to calculate before we actually go into this. So into the rest of this model. So now that it's being calculated, beforehand in the previous model, it was a hard code, but now it's not. Right, at least for historicals. And then for our conservative, aka the case we're creating beforehand, whereas we were just taking an average, now we want to actually go here and then get our depreciation of PP&E and then our amortization. And then this is now also a formula that we want. So we're getting our DNA and then dividing by our revenue. Okay, so we have our DNA, and then we want to do the same thing for our CapEx, where now we're not using the hard code. We actually have a figure that we want to reference. So we're going to make this purple. And we can actually just go across the whole thing. Make all of this purple. And now we want this as a percentage of sales. Make all of this black because now it's a calculation. Cool. So if you're just joining, we're going off of the previous model that I built, which is in this video's description. You can download for free. And then we're building off of what we had built in the past and adding basically like 100 new rows and making a lot of adjustments as we like kind of build through, build out everything. So, and I'm adding these periods for the rows in which we change something so that when you can later download this model, you can kind of keep track of what's been changed. All right, so now what we're going to do is, as I discussed here, forecast the cash flow statement. So essentially, we're going to replace what we did previously, where we had the levered free cash flow. Okay, so there's going to be a lot of kind of like new things that we add here. But essentially, we're going to be building out our cash flow statement. So we're going to start off with our net income. Then we're going to have our DNA. Then we're going to have changes in net working capital. Other long-term assets and liabilities. PIK interest, which is something we're going to add later. And this gets us our cash flow from operations. And this isn't everything. This basically, if we were to go to an actual cash flow statement for the company, there's a lot more in here that we would need to make adjustments to. But for our purposes for this model, we're not going to go through all of this stuff because I don't even know if I could really like project all of this stuff correctly. There's just too much. I'd have to study it quite a lot. What we're going to do for our cash from investing section, we're going to have capital expenditures. And then we're going to have our purchases of intangible assets. And that's going to get our cash flow from investing. Then we will need our mandatory debt repayments. And then that will get us to our pre-revolver cash flow, which will be a new thing we're adding. Then we will need our revolver and our post-revolver cash flow. Then we want our discretionary payments. For this, we're going to need I'm going to assume that we only have discretionary payments for our secured term loan USD tranche and our Euro tranche. This will get us our cash from investing. And then our net change in cash. Okay, so at this point, what we just need to do is link for a lot of these, and I'm going to highlight in yellow actually the ones that we're going to do later. So pick interest we need later. Same with our mandatory debt repayments, our revolver, discretionary payments. The discretionary just means payments earlier than scheduled when you want to do it, kind of, because that helps you kind of like paying off a house. If you're able to pay off your house more quickly, then you're able to own it more quickly and potentially increase your return. But for a lot of these figures, like net income, we need to just go to our income statement here. And we can just link to it. Make this purple. DNA, we just figured out. Changes in net working capital, that was the first thing we did in this video. Other long-term assets and liabilities. So this is where I'm going to kind of explain like why that doesn't really matter what these numbers really are, because what we're going to do is get for our other assets essentially, get our current year minus your previous year, because that's what you do for assets. And then liabilities, get your previous year, subtract out your current year. So essentially it's just going to result in 0. So that's why I was saying earlier, like, you know, just not something we really need to worry about. And then let's calculate our cash flow from operations, which is our net income. Add back your DNA expense, subtract out any changes in working capital, subtract out any other long-term assets and liabilities, and then add back your PIK interest because it's a non-cash expense. I will explain later what PIK interest is when we actually need to get to it. But for now, if you've been following along, then you can just copy paste this across, and then we have our cash flow from operations. All right, now next up, capital expenditures and purchases of intangibles. Very similar thing where we just need to go back to the top here and then find our figures. So we have intangible assets purchases here, right? And then cash flow from investing is just simply CapEx plus your purchase of intangible assets. Sorry, I couldn't kind of like froze up there for a second. I'm gonna add some borders here. Okay, so we can copy paste this across. So Control R. And then mandatory debt repayments we're getting later. All these things we're going to need to get from our get from after we make adjustments to our debt schedule. But something that we can do initially is uh, um, we can fill out these also a little bit later. So that pretty much is what we can get done with our cash flow statement for now. So let me again add these periods for the rows that we have made changes to. We're going to actually delete this levered free cash flow section that I had built in the previous model, but for now we'll just kind of leave it there. And then we're going to now make some heavy changes to our debt schedule. So this is where we're going to go over additional debt tranches, mandatory debt repayment, cash sweep, PIK interest. We're kind of going to tackle these three things at the same time, but for now, let me just add an X here. So additional debt tranches, revolver, and subordinated notes. So the first thing we're going to need to do is go back all the way to the top and then add our two new debt tranches, right? So here we have only secured term loan, senior notes. So what I'm going to do is add a row, Alt HIR, add a row down here. This is going to say revolver, and this is going to say subordinated notes. And then what we can do here, I think these should actually all be, oh no. I'm going to need to copy this formatting up top here. These should all be the same formatting. Yep. We're going to have 0. But if you actually go into the merger agreement, I think, actually no, in the 2011 10K, go where we got these pieces of information. A revolver is basically like a credit card for a company. So if a company needs to draw more money for working capital or to pay for cost of goods sold, whatever it is, they'll use a revolver basically. And it's actually not here. See if it's in here. This what I was talking about. Okay, yeah, it's here. So you can see basically with the merger, blah, 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 credit agreement here, a new senior secured revolving credit facility for up to $150 million of revolving extensions of credit outstanding at any time. So essentially what this means is that the company can draw up to 150 million. So I'm going to add a note here in 2011 10K E, page 105, can draw up to 150 million. Right, but it's going to be 0, but just good to know that, right? I think these actually also I need to write 10KT. Yeah, I'll add this too, so it's even more clear. Also, I realized I forgot to answer questions in the chat, so let me do that after I adjust these comments. If you guys have any questions? I'm going to copy this comment, Alt ESC. Let me see if there's questions. I want to learn private equity. What are your thoughts about the courses provided by Financial Edge? Financial Edge, worked with them in the past. I think they also have good courses as well. And they have the previous instructor who taught me during JPM training is the founder, I think, of Financial Edge. And so, yeah, I think it's a good course. Can you speak Korean? Yes. To get rid of circularity, do you equals if on all average functions? No. Circularity is more about the cells that are basically affecting each other. And if there's like a circular reference, it doesn't have to do with like whether you use an if statement or an average statement or anything like that. Also, I realized, dang it, I just realized I have this meeting. but I need to move it. So give me 1 second. Let me message. My bad, everyone. I see the depreciation change could be due to finance lease depreciation being added. You need to look into the notes. Near impossible to recreate historical financials. Yep. Okay, just join. Maybe some. All right, cool. All right, so interest rate also is here somewhere. Not gonna really matter. Actually, well, might as well get the right number. What I'm looking for right now is the interest rate for the revolver. Okay, so 4.5% for loans under the US dollar denominated tranche of the new. I think that might be same thing. Okay. All right, so this 150 million thing is called the new revolving credit facility. Think. And then here it says new revolving credit facility adjusted, blah, 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 plus a margin of 4.75% for 4.5% for loans under the US dollar denominated tranche of new revolving credit facility. So 4.5% interest rate. So let's add 4.5 here, and then let's add that this is from 2011 10K T page 106. Just, yeah. Fees. The company is not taking any out, so there should be a percentage here. Let's just call it 2.5%. But since you're not taking anything out, it's just going to be 0. The term loan thing here, like it said up here somewhere that it was going to be 5 years. So, was it 6 years? A new revolving credit facility has a 5-year maturity. There's 5. And then amortization is going to be 0 because we're not actually using it. All right, so that is the revolver. And then we're going to add something called subordinated notes. And so subordinated notes, this is just going to be purely for illustrative purposes. I'm just going to call it, I'm just going to add a note that says illustrative here. Interest rate, let's call it just 10%. Copy paste this, call it illustrative. Fees, let's just call it 2.5%. This formula here, let's call this 5 years. Illustrative. And then I'm going to add something over here that's called PIK for the PIK interest rate. And I'm going to call this 5%. And we're going to get to this later. We also want to make sure this is correct. So this is 7 to 31. So now we have updated our capital structure here. And next we want to make sure that we also add things or add this into our sources and uses, which won't really change because these are going to be 0. But later on, when we play with the model, you're going to see, or you want everything to be working basically, right? So cache, I think all of this is working. This needs to, yep. So this is a check. It's 100%. 9.6 also matches 9.6 here. Cool. So let's say we add 100 here. Everything should change a little bit. Why is this negative 19 though? Oh, this formula should not have copy pasted that. This is just this. This is missing. Oops. Okay, now everything works. Good thing I double checked because I had done that a little bit wrong. Yep, so but sources and uses, equal to each other. All these numbers tie, so we're good. I'm going to put these at 0 for now, but later you'll see that the model will get super interesting when we actually add these in with like everything fully built out. All right, so we have long-lived assets. We just added our additional debt tranches, and now we need to add them to our debt schedule. And this is where things are going to get pretty complicated. Actually, maybe not that complicated, but it's going to make for like a very, very robust LBO. So what we're going to do here is first off add the revolver. So let's add revolver. I guess we could just do it this way. We're gonna want a lot of these things here, but a lot more. So we're gonna want our beginning. The revolver is gonna be a little bit different, and I will explain what the revolver. Actually, I kind of already did explain, but you'll see why we need to do all this extra work. Basically, beginning excess cash, free cash flow generated. This gets us to our cash available to pay down or draw from revolver. Then this gets us to our beginning balance of our revolver, increase or decrease of our revolver, ending balance, and then we're going to want to do a check of maximum availability, and then a check. So let's see, cash figure we have. I think this one, these all just stay the same. Actually, double checking with the model I built. Okay. So we actually do need, I'm going to add periods for everything that we're going to need to change here or have changed. Actually, this entire section is going to change. So we have our ending balance, which is just the cash on the balance sheet as of the announcement of the transaction. And then this is our minimum cash balance. So it doesn't equal our ending balance, but we're assuming that, okay, once this company has been acquired, the company uses some of the excess cash in order to pay for the transaction, which we did in our last video. And this is where things are a little bit different. We're going to need an inflow and outflow of cash and link this to our net change in cash. So whatever change we have in our net change in cash is going to be what affects our cash balance. And we are adding this now because we projected out our cash flow statement, right? So this is linked to it. Whereas in the last model, we did not project out our cash flow statement. Not going to really change much anyway, but good to have this. Okay, so ending balance is same thing as our beginning balance here, because, and we can just link to up here. Revolver, so we're starting with 0. We don't even really need to have it here. We can just start with our beginning balance up here. But this is how I did it in the model. Actually, I don't even know if this is how I prefer it. I think I kind of actually just prefer it being back up here, but whatever. It'll just keep things consistent. Okay. So beginning cash balance we have here, right? And then our minimum cash balance is, we can link back up all the way to our transaction financials and assumptions. Minimum cash is here. And this is what we're always going to want to keep it at. So this will always be there. Beginning cash balance will always link to the beginning cash balance there. And then so our excess cash is the beginning cash balance minus our minimum cash. All right, so let's say this happened to be 130, then we have $12 million in excess cash that we can use, right? Then we need to calculate our free cash flow generated. And so this will be our pre-revolver cash flow. So everything is setting up for the revolver right now. So this is 0 right now, and we will make adjustments to it later. But see, actually, I think we can calculate this right now. Yeah, we should calculate this first. So pre-revolver cash flow is actually just your cash from operations minus your cash flow from investing. Essentially, that's actually very similar to our levered free cash flow, if not actually kind of is, because we have our net income plus D&A minus changes in net working capital. We also added these two line items, and then we're subtracting out our CapEx, which essentially is what we're doing here. Mandatory debt repayments we are going to be adding as well. So this pre-revolver cash flow you can actually think of as your levered free cash flow. Right? So if you think about it that way, you just need to get your cash flow from operations minus your cash from investing. That gets us to the cash figures here. And what this is basically saying is that the free cash flow we have, let's see, cash available to pay down or draw from a revolver, it should be your beginning cash plus your free cash flow generated. And as we're going through this section, honestly, it's quite complicated even for me. So I'm going to have the model that I built to, as I was preparing for this video, up screen over here. And I'm just going to be double checking because I don't want to lead you guys astray. So basically what this is saying is any excess cash from your minimum cash required plus the free cash flow generated, that's the amount that you either have available to pay down the revolver if you need to pay down or draw from the revolver. So let me show you, and we can copy paste this because all of this is correct. So let's say that I Actually, let's build out the rest of this, and then I'll show you guys like what all of this entails really. The beginning balance we have here, increase or decrease. So this is where we want to get either the minimum of your beginning balance or the levered free cash flow, or the cash available that you have. So negative min, either this number or this number here. It's going to be 0. And then ending balance is your beginning balance plus your your increase or decrease here. Maximum availability, I'll go through in a little bit. Essentially right now, your cash flow is positive, so you don't need to draw from your revolver, right? Like let's say you have $23 in the bank, just you as a person, and you want to go buy a t-shirt and it costs $15, right? You don't need to go to use your credit card if you don't want to. You can just use that $15 in cash you have. But if let's say you're trying to buy a $100 t-shirt and you only have $25, then you're going to need 75. So that's what this model is basically kind of built for right now. So let me go show you an example. What I need to change basically is to have this cash generated to be a negative number, which is definitely possible, right? A company can have a bad year and have negative free cash flow. So let's say that just for example, this is the capital expenditures is like let's call it 300. So we have negative 94 in free cash flow of this year, right? So then we have negative 94 in free cash flow generated. And so you can see this part here where it says draw from the revolver. We need to draw 94 million. So what this does is your beginning balance of your revolver is 0. And then you increase the revolver by 94. And your ending balance is 94. What this basically means is that you're using your company credit card and drawing $94 million from this revolver. And that's what this basically does. And then what in future years, based on this formula that we have built out here, if you have positive free cash flow, you're paying down your revolver. And you should always kind of be paying down you're likely always paying down your revolver first because it's a short-term debt. And that's how you kind of want to build things out. And so that's what we've built out here. And this is your revolver. So I'm going to go back and undo what I did here. Essentially, this revolver you don't even really need in this model because your cash flow is positive. But for almost LBO, every LBO that you'd want to build, like in banking or for a client, you're going to want to build out a revolver. Very, very important. Okay. The maximum availability, we went through earlier that it was 150 million, right? So I'm going to add 150 here. And this, we're just going to want to check, right? So if this ending balance is if this ending balance is greater than this, then have like overdrawn. If not, then okay. Normally just make this red. But basically what this is saying is, let's say that we go back up again and make capital expenditures like 500. Right? This makes us draw $294 million from our revolver when the maximum is 150, right? So this is a problem because you can't draw over your credit limit, right? So I'm going to add up here where we have our IRR for reference. We're going to have, let's call it revolver check. Usually, you know, future years, there could be issues and whatever, but usually you're just going to have a potentially overdraw in your first year. So not going to worry about the other years. But even if you were to, then later on, you could obviously just like check this and see if you're overdrawn. But that is the revolver. And Very, very important part of almost every company's debt tranche. And let's see what we did here. So we added the revolver and subordinated notes. Now something we need to add for as we build out this debt schedule more is mandatory debt repayments and then our cash sweep. So these are two things we're going to build out next until we finish out with these last two items. So let me first kind of go over conceptually what mandatory debt repayments are. So think of it as like a house. Whenever you take out a mortgage, you can pay every month if you want, but then I think I remember reading from like Rich Dad Poor Dad, which I think is accurate, that if you actually pay every 2 weeks, then your interest that you actually pay gets lowered each time you pay down your principal because your principal is getting smaller. So then if you just pay like every 2 weeks instead of every month, then you can actually shave off years of your mortgage if you have like a 30-year mortgage or something like that. And similarly for a company, when you do a leverage buyout, you're taking on a ton of debt and then you are paying off your, let's say, mortgage, which is AKA your debt principal. And if you pay off your debt principal faster, then it's better for your returns, right? That's one reason why you might pay off your loans faster. But the other reason is it may be mandatory. Your bank may require, for their own safety, that you pay off a portion of the loan every year in a certain amount. And so that's what we want to build out that flexibility in our model. So what we're going to do, and not every debt tranche or loan requires that. A lot of times banks don't want you to pay these mandatory debt repayments early, because then it lowers the amount of interest that they are actually going to be able to collect, right? So for secured term loans, we're going to add this mandatory debt paydown, versus for our subordinated notes. Actually, sorry, we're gonna build it out for every tranche, but we're not going to actually require it. We're going to make things flexible. Okay, anyway, so let's just build it out first and you guys can see where it ends up. Mandatory pay down. Just going to add it here for each of the tranches. And then we're also going to need our new tranche that we added, which is our subordinated notes. This is going to be a little bit different. Beginning balance, mandatory pay down, pick interest, and ending balance. But we'll go through that later. All right. So we're going to be adding a few rows underneath here for each of the debt tranches, and what we're going to call them are mandatory pay downs, percent of initial amount. And then down here, we're going to want what we are going to call our cash sweep. All right. So let me adjust some of the formatting, or prepare some of the formatting before I go into this actually. Where is that thing? Oh, here it is. Okay. Okay. Here's that. Okay. So mandatory pay down, what we are going to want to, or what this is basically built out for, is what percent of our beginning balance do we want to pay off each, or are we required to, or slash do we want to pay down each year? Or sorry, no. Mandatory pay down is required, right? Mandatory. So this is the portion that you need to pay down based off of the contract that you sign with the bank. Cash sweep is going to be what percent of the loan do you want to, or what percent of the cash flow that you have available do you want to use to pay off this debt early? So basically think this as mandatory pay down and then this as optional pay down. Let's call it 0% for now. Okay, so for mandatory pay down, we're going to need to use a new formula where we're getting basically the minimum of either our beginning balance or the minimum of your beginning balance or your beginning balance times your percent that you need to pay down. Right, so pretty simple formula here. The pay down figure from excess cash flows. See what we have here. I'm going to actually change this number. So we're going to delete this for now. And then what we want to do is get our amount of cash that we have available, essentially. And so what that will look like, let me just double check. This is the part where it gets like really confusing. So I need to make sure I'm doing this correctly. Cash available from Revolver multiplied by, or okay. So the amount of cash that we have is the cash available to pay down or draw from the revolver. So this is essentially right now our free cash flow because we're not drawing, or this is basically our free cash flow that we've generated. And then any increase or decrease in the revolver, right? That is our amount of cash that we have available. And then what we want to do is multiply this by the percent we want to, or by our cash sweep essentially. And we want to anchor this by pressing F4. So right now we want to use 0 of this cash, right? Because we put 0%, but if we put 100%, then we're taking 23 of this $23 million. But if we want half, then we have half. And this is going to determine basically how much we're going to pay down. So that's why we deleted this, because the number, or the formula now is different. Right? So now what we want to do is, in order, here, our pay down from, I'm going to title this pay down from excess cash flows. Okay, so now what we want to do here is either get the minimum of the cash sweep or the difference between the beginning balance and our mandatory pay down. So equals min, either our cash sweep or the beginning balance minus our mandatory pay down. But as you can see here now, right? So if I change this to 100%, this changes to 23, this changes to 23 million. Mandatory pay down 0, but if I'm, let's say, call this like 1%, this changes to 15, and this changes to 23. Wait, hold on. But then this should not be. Okay, wait, I need to change something here because the amount of cash that we have available is 23, so we should never go over the amount available. So okay, let me figure this out. So amount, this is linked to this. Pay down, mandatory pay down should have higher seniority. So then mandatory pay down is either this times that, meaning this should be the minimum of 230 or oops. Okay. This is why we have our circuit breaker. Okay, so what we want is that if I make this like 5%, this should only be at max 23 and this should be 0. So this should not be higher than this number. Hmm. Uh, I'm trying to figure things out on the fly because I realized that in the previous model that I had set up, I did not do this correctly. So this may take me a little bit of time to figure out. But it should be either the minimum of this or this times this. So that's right, but then this actually should not be linked to that. It should actually be minimum of the free cash flow generated minus the increase or decrease, or that. It'd be 23. And then this should be 0 right now. But this should actually be equals the minimum of either mandatory pay down minus cash sweep or right now I have min G20, G230 or G224 minus. Oh wait, you know what? I think if I just changed this formula, everything I just did would work. Sorry about this, guys. I know it might be painful watching me do this. Just double check something that I was doing. Oh, you know, that doesn't work anymore. Okay. Basically, if I need to make it so that if this is greater, maybe I'll just use an if statement. So if that figure times the percentage is greater greater than mandatory debt figure, then oops. That's greater than give me that. If not, give me 0. So and then I think if we use that min function I had earlier, either this or this minus this. Okay, it works for now, but always always never know until you stress test everything. Okay, so let's try making this 50% and taking 50% of that. Okay, so that works. Mandatory 100%. Oh, wait, the mandatory debt pay down is actually not be linked like this. Hmm. Still doesn't work. Okay, so I feel like I should be doing something a lot more simple. 18. Yeah, sorry guys. So this was actually correct. This should always be this, no matter what. What this is basically saying is mandatory pay down. Well, you always will need to have like whatever the bank makes you pay, you will have to, right? Let's say you make this 50% and it's super high, then honestly, I don't think you would ever build the model that way. But okay. And then pay down from excess cash flows. This should be minimum of your cash sweep minus this, or yeah, minus this, or this, or this minus. Okay, so that works. Don't want it to be negative. Oh, maybe in the interest of time, I figure this out for part 3, because I think for now, this, I mean, a lot of this works, but don't want to waste too much time on this. I mean, if as long as you basically, if you put something crazy in here like 50%, then this breaks. But as long as you put something reasonable, like if you put 0 here or 1%, then everything works the way it should. Let me just add a note here. Fix this for future, for part 3. Okay, so sorry about that, guys. I know that might have been painful to watch, but essentially a lot of this should work as long as you don't put like, again, something crazy here. But with that said, your model should ideally be able to handle whatever issue, whatever crazy things you do put in there anyway. Okay, let me try this for like 1 or 2 more minutes. If I can't, then I can't figure it out, then I won't do now. So what I want this to be, oh, maybe it's also because I added all this stuff. I think that's necessary. Bum, bum, bum. We're getting either 230 minus 225. This, it would work, but oh, actually that works, but we don't. Mandatory paydown is either the smaller of G224 times 229 or 224. So it should either be minimum of that or cash flow generated this. All right. I think that works. Oh, no, it doesn't. 15 and 20. This should be 8. Either the lower of 230, 24 minus. All right. So I think, yeah, sorry. Gonna have to fix this in part 3. Again, though, as long as you don't put anything crazy here, I think what I'm gonna have to do is make this limited to only a certain percentage, or something like that, or make it so that if you draw too much, then you draw from the revolver, which like is kind of possible. But right now, functionally, as this should still kind of work. So your mandatory paydown is still linked to your percentage that you have here, and then the amount of cash sweep, amount you're actually going to use to pay off debt when you decide you want to, is all kind of still working here. So let's just keep moving for now, and then I'll fix things in the next stream. Try to figure out like what the issue is there. And yeah, honestly, I'm a little bit rusty with LBOs just because I haven't done them kind of in a while. Except honestly, the most recent one that I streamed. Okay, so let's see here. Just ooh, what is this one? Trying to be lazy and right. Okay, so basically we're just copying the same thing so that we are building out the same functionality. Okay, so mandatory debt pay down, again, similar thing. Copy this down here, except make this down here, and then beginning balance, and then okay. This needs to change too. Okay. So we're at the Euro tranche. I'm gonna actually revert to like I'm not this kind of works right now, but then I feel just a little bit hesitant about it, to be honest. So I'm actually gonna revert to what I had built in the past and then rebuild it later in the next stream when I like figure out how to like make all of this dynamic. So what I'm gonna do here is minimum of 218 beginning balance. I'm gonna delete all this. I'm gonna go back to what I prepared and then figure things out later. So equals min of either beginning balance times your CAD mandatory. Or your beginning balance. Okay. Mandatory pay down, what this is basically saying is get either the minimum of your beginning balance times the mandatory pay down or the beginning balance. And then pay down for cash from excess cash flows is either going to be the minimum of your cash sweep or the difference between your beginning balance and mandatory pay down. So minimum between your cash sweep or your beginning balance minus your mandatory paydown. And then we're going to need to have our cash sweep formula as well, which is your cash available to pay down from Revolver plus your ending balance, or plus the increase or decrease in your Revolver. I don't know why these numbers got weird too. Oh, there we go. Okay. Okay, so I'm going to keep this for now. And this technically still works for now. So 1% here, or actually no, let's call it 0% here, 1%. Yeah, we're going to need to make some protections later, but if you're, let's say hypothetically needed this like ASAP, then you could just make sure that putting like 1% here and then like 2% here, making this like 0. Okay, so let me just add to the list for part 3, fix mandatory debt repayments and cash sweep here. Man, sorry it took such a detour. Didn't realize that I did not have that built out correctly, basically. But for these next ones, essentially you can kind of copy paste across or down. Oh, actually these are kind of anchored. Or copy the formula. Put it down here. But I think you also actually need to subtract out. Yeah. Your, so this is where like the waterfall portion comes in. So you can only use the cash that's available after you've already paid down the first tranche, right? So what I've done here is basically we're getting our levered free cash flow plus any increase or decrease from our revolver, then subtracting out any cash that we have used to pay down any excess free cash flow. And that gets us to our figure here. So let's say that, actually, let's build the rest of this out first. So mandatory pay down, we can use similar formula for now. Let's see if we can just copy paste these. Yep. So let's say that you use 50% here essentially, and then you want to use all remaining cash or 50% cash or 100% of the cash that's remaining, then you can see that it takes from this 23 and then takes what's remaining, right? We use 100%. If you use 100% here, these should all be zeroed out because there's no cash remaining essentially. And it has like parentheses here, but then essentially this is pretty much 0. Then the reason that it might have these like parentheses zeros a little bit is because it may be due to like the iterative calculations. It makes it so that it's like 0.000001 or something like that sometimes. But essentially you can see that 0. Okay. Senior notes, mandatory pay down thing, same thing. So we're just going to build out the functionality just to have it, but then not necessarily not going to actually use it. So pay down again, you should be able to just copy paste this again. But this drag down here. Actually, it's easier if we use this formula. This minus the pay down from excess cash flows. All right. So to see if this is working, essentially, let's say that we made this 0. Then the cash that you have generated is 23, 56, 123, all of this should all be flowing here until you pay down everything. And then it should flow down here, right? Let's say you're for whatever reason you don't want to pay down. This should be oops. And these should also zero out, right? But let's say you want to use like 100%, then this should go up to the amount of cash you have. So that's cash sweep and mandatory paydowns. We're going to build out the subordinated note, although I might leave it until next time, given how long this has been taking. Oops. Oh, it's been 2 hours already. Okay. Go on maybe for like at least 15 minutes and see what we can get done. But to quickly kind of again summarize like what I had been building here and where I got tripped up. Mandatory paydown. This is the amount that you can actually pay your the amount that you're going to be paying off the principal. So let's say this is 1%. Then this is the amount that you are paying down of the principal. And this formula also wrong, I just realized. This should actually also subtract out your mandatory paydown. And let me make that fix for all of these. Mandatory paydown and then discretionary. So then let's say, well, this shouldn't work right now, but actually, if I do that, okay. Oh, this should be 23. Sorry, I'm like so obsessed with trying to figure this out, even though maybe I shouldn't try to do that right now. Min either of that, maybe I add another one. Okay, I think this works. Okay, I think at least I think I figured it out. Okay, cool. So I added this formula here. And I'll have to double check later if this works, but it seems to be working right now because this is the maximum of, or it doesn't go ever higher than the cash that we have up here. And this cash sweep, you always want it to be, you never want it, if you have a mandatory pay down, then that gets paid first, right? So that maximizes your cash sweep in a sense. So what I've done here is either got the minimum of your beginning balance times your mandatory payment, or your beginning balance, in case that's the lowest, then that's the lowest you want to pay, or your cash generated plus your increase or decrease in your revolver. So I believe if I fix that for all of these, then this will work. This be this subtract your mandatory pay down. And then it's the max. All of that or 0. This should be 0 because we're using all of our cash. Let's see if this fixes that. The min of your min of your beginning balance times your mandatory pay down, or your B224, which is your beginning balance, or that plus that. Minus your pay down here. Okay. If I make this 2%. Nope. All right. Yeah, I can't figure this out now. Sorry, guys. Also really tired. So I'm going to go back to what I had, and then, as I mentioned, fix this later. Okay. At least part of the functionality is built out here. So let's see what I was supposed to do next anyway. So we did mandatory debt repayments, cash sweep, PIK interest, and then we have amortization of financing fees. We may, okay, I guess this part's not too bad, so I guess I can just try to finish this out. But this stream is also going longer than expected, because I messed things up a little bit. But okay, so ending balance, this is going to be similar where we have the balance here, but we're starting with 0. And then the beginning balance here. Mandatory pay down. This is the thing we were building out earlier. And then what we're doing here is same formula, either the minimum of this times your beginning balance or your beginning balance. And then pick interest. Let me now explain what pick interest is. So pick interest really sounds really complicated, but it's really simple. Essentially, it's you have two options when you take out something like a subordinated note, where you can either pay normal interest, which is just called like cash interest, and you can just pay that to contractually meet your requirements for your loan, or you can add what's called payment in kind interest, which adds interest to as principal to your debt or to your loan. So, for example, if you have $100 loan and you have 10% PIK interest, you can pay 10% of $10 basically and add that to your loan so that it's at the end of your first year, you have a $110 loan. And then your second year, 10% of that is 110, so 11. You can add that to your, I should just show you with numbers actually. Let's say it's $100 at beginning, at the end of the year. And then you add 10% interest. So that's was 10% times your figure here. Then you have your ending balance of 110 and then et cetera, right? So that's basically what PIK interest is. Let's kind of build this out. So what we're going to need to do is actually add a switch because typically it's not always the case, but you can either choose to pay your cash in or you can either choose to pay your interest in through cash, or you decide to use a PIK interest. And the reason you may want to use PIK interest is because, let's say for whatever year, 1 year is really, really tight on cash and you want to save on, or you want to use your cash for elsewhere and not pay off the loan. So that's a reason why you may want to use PIK interest. Wait, let's switch this up. So cash, PIK. I'm going to call this switch PIK, P-I-K. All right, so the PIK interest here, we have a figure like up there that we're going to use. But essentially, the reason we want to build out some functionality here is because you are most likely not going to have to pay both cash interest and PIK interest. You're likely just going to have to choose one of them, right? So let's say that if PIK equals 2, which means that it's on, then we're going to want to get our beginning balance and multiply that by our PIK interest we have up here, 5%. If not, then this should just be 0. All right, because if we decide to pay with our cash interest instead, then it should be 0. Okay. So let's pretend that we go back up here, and then for our subordinated notes, let's say we have 100. Then when we go back to down here, you can see that our interest is actually increasing. And then the loan amount is actually increasing. So that's what we want to see there. Because this stream is going longer than expected, I'm going to actually add the amortization of financing fees over here because it's actually pretty simple and easy to do. PIK interest, I think, is also a lot more important than amortization of financing fees. But now that we have built out a lot of this, what we need to do is 2 steps left. Go into our interest payments, make some adjustments here, and then finish out our cash flow statement, and then we're done. So hopefully around like 10 more minutes or so. Okay, so we're gonna need to add, why am I messing this up? Okay. Our revolver. So our interest rate is all the way up there. And again, it's gonna be 0 right now, but fine. Interest rate of 4%. Oh, I also realized we need to add these. So we need to add our revolver ending balance, and then also our subordinated notes. Then same for beginning balance. We need to go back up, go to our revolver, then also our subordinated notes. Then this also needs to include hash increase, decrease, plus. Just pay down. I don't actually need this, but let's see. Pay down from excess cash flows. Need a lot of these. So equals this plus all these different pay downs. $260 minus. All right. Okay. Sorry I've been quiet. I've been thinking while working on all of this, but essentially what we did here was just kind of add everything together for our ending balances, our beginning balances, our pay down, etc. And now what we just need to do is calculate our interest rates and then finish out our cash flow statement. So this stuff should be relatively simple. So what we have the circuit breaker thing on. We just want to make sure it's linked to the right spot. So this should go to our revolver ending. It's the average of our beginning balance and then our ending balance. And then you multiply this across. You get to your, basically it should be 0 because we're not using our revolver right now. These should not be affected because, yeah, it's just your beginning and ending balance. So I'm going to add the periods here and here for things we've changed. Senior notes, also no changes, but we do have some new line items that we need to add here, right? So this one is subordinated notes. And then we have an cash interest rate. And then we have the PIK interest rate. And for this one, the cash interest rate, we have the 10%, which is here for illustrative purposes. And then we want to change this to be adjusted for our subordinated notes, beginning balance, average of your beginning balance and ending balance. But you actually need to make this dynamic. So if you want, if PIK equals 1, then you want what's here. Otherwise, you want 0. That way, you're not double counting the interest for this. And then for this, and should be your average of your beginning and ending balance. Actually, wait. This can just be referred to what's already been created up here. PIK interest. So we've already calculated this, so it's fine. And then for the PIK interest rate, we can just go here. But that is our total interest expense section, or the interest expense calculation or section all calculated. You just need to make an adjustment here where we are adding a revolver plus our subordinated notes cash interest rate plus our PIK. Cool. So now we have our blended interest rate, and now we can go back up here and then fill out basically all the stuff that we left and needed to fill in. So PIK interest rate, you can go down and refer to it here. And then mandatory debt repayments, you can just add each one we have here. So mandatory debt repayment. Kind of need to do some scrolling, get to each one. Oops. Subordinated notes. So there are your mandatory debt repayments. This will lower your revolver free cash flow. And then revolver, this is how much you're increasing or decreasing your revolver. So your post revolver free cash flow is your pre-revolver free cash flow plus your revolver. Let me just double check that though. Yep. And then discretionary payments. These are Pay down from excess free cash flows. This is for the USD tranche. And then the European tranche. Discretionary just meaning you decide to do it. Not mandatory. So then you get your cash from investing, which should just be your post-revolver cash flow minus your discretionary payments. And then your net change in cash should just be post-revolver cash flow minus your net change in cash. Or, oh wait, I did something wrong here. Okay, mandatory debt repayments. 15 post. Oh, oops. The pre-revolver cash flow should also subtract out your mandatory debt repayments. Also make this 0 for now. Okay. The mandatory debt repayments. See if I did this correctly. Mandatory. Right. Cash flow statement. Blah. That's right. That should be right. Mandatory debt repayments. Okay. Okay. So let's see. Something is amiss. Revolver 0. That's correct. This should be purple. Revolver cash flow. Or post revolver cash flow. Pre-revolver cash should be cash from operations minus cash from investing minus mandatory debt repayments. That looks good. Revolver. Add together. It's good. And then discretionary payments. This 0. Zero, 0, 24, okay. All right. Net change in cash, 0. Cool. Okay, I think this is correct. Also, I also built out cash sweep for senior notes too, so I guess I realized I should add that as well. Discretionary payments. Okay. Oh, so I know well actually one thing that I should check is if this has any dependence. So this actually can be deleted now because we went through using all of this stuff using all of these cash flow figures here now instead of that section. Um net change in cash when everything is not being the cash sweep and stuff is not being used should be 0, so that's correct. I believe if we change this, things look a little bit different. Oh, never mind. Cool. So basically what this is showing is that, wait a minute. Six, 20. This looks weird. One sec. Discretionary payments, cash from investing, post revolver cash flow minus our discretionary payments. I think that makes sense. This number should not be higher than this number, basically. I think has to do with okay, revolver 1163. Minimum cash, excess cash, free cash flow generated. Beginning cash balance. Okay, this makes sense. Why is this so high though? Beginning cash. Up. So there's something wrong that I'm doing here that I'm not sure. I'm not sure what the reason is, to be honest. It'll take me some time to debug. Basically, the issue is that when I change this percent available, you can see here the net change in cash is 0. It should just be 0 because any additional cash that's being generated right now, we're using to pay down debt. And so the cash, net change in cash should just be 0. So let me try to figure this out and then end the stream. I want to end with like a model that you guys can build towards. I'll try to add in the notes, like try to skip these sections so that you're not like watching me try to just figure some things out. But this would be a good example of what also just happens on the job is something going wrong in your model and then you having to spend a ton of time trying to figure out what it is. That looks wrong. 1T. Is cash sweep. Oh, wait. Cash sweep figures again. Right, this issue here. Why is this so high? This is available, generated, beginning excess cash. Beginning excess cash. Okay. Fine. Hmm. That. Changing cash. Oh, I think I figured it out. Okay. Okay. I think I know what I did. But this should actually just be your post revolver cash flow total. Ah, so dumb. All right, there we go. All right. So I realized that when we already take out our cash flow from investing and all of this, this doesn't lead to our cash from financing section, which is like what I was confusing this with. our net change in cash, as long as you just get your post revolver cash flow and minus your discretionary payments, this is different from like a standard cash flow statement. I named things wrong, so I kind of confused myself. But essentially, our net change in cash is if you get your post revolver cash flow, which is your pre revolver cash flow plus your revolver, which is your cash from operations minus your cash from investing. That gets you to your net change in cash. Essentially, like all the cash flow that you have plus any revolver minus any discretionary payments, that's your net change in cash. And so had that formula wrong, but now that fixed, if I were to make this like 100, I guess, okay, if I make this 0, everything should still work. So you can see that if you have a cash sweep, you decide, I don't want to pay my USD tranche first. I want to just pay the Euro tranche first. Then that's, you put a 0 here, then none of this is being paid. But afterwards, your Euro tranche is 100% being paid for next. And then let's say with available cash, you want to pay your senior notes, then you can see that all available cash is going there. And while all that happens, your net cash should be 0, basically. So thank you guys for tuning in. If you guys have been watching this whole time, honestly, I struggled through quite a bit of this myself, and this happens all the time on the job as well. And it's why modeling can be interesting, fun, but also you want to pull your hair out sometimes. And in a more regular setting, like I would, just be working on this by myself. But then I usually try to prepare the model in advance so that I can kind of go through things quickly and explain well to you guys. So apologies for this one, where I think at least for 30 to 45 minutes, I was struggling through some of the formulas. Let me now just finish off by answering some of the questions you guys may have asked. Terminal value, that's for a discounted cash flow, not for the LBO, but it's the remaining amount of value post your last ending period of projections. Like, so what is your company worth after your 5 years of projections until the end of time? How do you recommend someone to practice building DCFs if they have not facts, if you don't have facts set, basically? I think it's really tough. You can just go based off historicals is the best you can really do, unless you can pay for some kind of estimates. But I will say, even if you find a company where you can get estimates, usually they're not going to be that great. Because even analyst estimates from like the best banks in the world, a lot of times they're very wrong. Yeah. So love your long form videos. Would you consider doing a more strenuous 3-statement model into a DCF? Yes, I will try to do that in the future. I need to like brush up on some things. First time for tuning into live stream. Thanks for doing this. Oh, thank you, Richard. Appreciate that. How do you validate a model? So I guess a lot of times you want to, you look for the important figures and kind of like stress test it, right? So like right now, what we're getting with everything that we built out is a 22% IRR, which is reasonable, right? Like if you are in a private equity company, you want a 15 to 30% IRR. If this IRR was 50% or negative 10%, then you know that's probably something's wrong, because this is an actual transaction that really happened, and you're not going to pursue an LBO if you're getting like negative 10% in a model. Just in general, do search fund internships look good on resume? Yep. I'm in middle office right now. Am I cooked? No, I think you just want to keep going and maybe lateral to a different office or group or whatever you can to, keep going forward. But thank you guys, as always, for tuning in to this stream. As a quick note, I will have to make an edit and change to some of the formulas in the debt schedule section. But most of this model is fully functional and should work pretty well. So I will have this available for download as soon as possible, and you guys will be able to download it. In the next stream, I'll let you guys know how I fixed the cash sweep mandatory debt repayment issue that I had. When you get this model, you will see all of these different like videos you can look at, and then later on, may not cover all of these things, but this is what'll come about from part 3. So thank you guys for joining, and hope to catch you on the next video or stream. Thanks, guys.